All right, let's get this started. Very short presentation, just an introduction into the DSER programs. So welcome. We're moving into a new era of real estate investing. If you ever felt like the bank's making it impossible for you to grow your portfolio because of outdated rules, this is going to be for you. So today we're talking about a tool that is redefining how to build wealth in 2026, and that's the DSCR loan. So, what is a DSCR loan? It stands for Debt Service Coverage Ratio. It's a mortgage product specifically built for investors. And unlike traditional loans that look at pay stubs or paychecks in your tax returns, this loan looks at the property's ability to pay for itself through rental income. Why is that important right now? Well, the world has changed. More of us are self employed or are part of a gig environment. Traditional banks hate irregular income or big business write offs, but DSCR loans solve that problem. Plus, the demands for rentals, both long term and Airbnbs, is through the roof, and this loan is designed to support that growth. So, let's look at the math. And don't worry, it's very simple. We use a basic formula. DSCR equals rent divided by principal, interest, taxes, insurance, and association dues, or mortgage payment. Essentially, we're asking, does the rent cover the bills? Lenders want to see a ratio of at least 1.0 or greater, which means the property breaks even or makes money. If it's higher, like 1.25, you're in a great spot for even better loan terms. So when we say rent, we mean the gross income the property is expected to make. For long-term rentals, we use an appraiser's market analysis, or the lesser of the appraiser's market analysis, and if there's an actual rent already in place. So if it's property's occupied, the most lenders are going to use the lesser of those two. For vacation rentals like Airbnbs, they use historic data and smart tools like AirDNA to see what the property is really worth in the market. So what are the bills we're talking about? We call it PITIA. So P and I equals the property. It's the principal and interest. T and I equals taxes and insurance, so real estate taxes and homeowners insurance. And then the A is association dues like HOAs or condo fees. And that makes up your complete PITIA. So here's a breakdown of what we look for. So one is breaking even. So if the rent is $1,000, mortgage payment is $1,000, that ratio is going to be 1. Above 1 is what we really like to see, and that's a healthy one. That's where you're generating cash flow. So rent is 1,500, mortgage is 1,000. You have a pretty solid cash flow at that point in time. And below 1.0 means you're actually having to come out with money every month out of your pocket to cover it. So rent is 1,000, mortgage is 1,500. You need to bring up the extra $500 to close that one, or to pay the rent. Sorry, to pay the mortgage. These are possible. You can do. There are more lenders that do under 1 ratio, but they do typically require a much greater down payment. So this is where the magic is. DSCR loans require 0 personal income docs or tax returns. If you're self-employed and your tax returns show a lower income because of the deductions, it doesn't matter here. We focus on the assets performance, which makes the whole process faster and much less stressful. So keep in mind these are exclusively for investment properties. So you cannot live in any of these properties. They are only for investment properties. So whether you're buying a single family home for a long-term rental or a condo short-term stay, this playbook is built to help you scale your portfolio without hitting those personal debt ceilings. For those looking for vacation market, we use a professional market analysis tool like AirDNA or MashVisor. Lenders will even factor in seasonality. So if your beach house makes more money in the summer, we account for that to make sure the loan is safe and viable. So now let's talk a little bit about the numbers. Loan to value for purchases, you're usually going to put about 15 to 25% down, depending on the property type, your FICO, Um, and then and the loan amount also can dictate the max loan value. Rates expect 6% to 8.5%, which is a little bit higher than normal standard home loans because of the flexibility of the loan and the risk that the lender is taking. Also, I want to point out that to get those lower rates, there are features added into these loans. They're called prepayment penalties. Um, not every lender forces you to have them, but to get the lower rates, you typically need to include them. They're anywhere from 1 to 5 years, but to see those lower rates, you need to see a 3 or 5 year prepayment penalty. Um, and if you ever want to discuss that, we can talk about that another time. But just keep that in mind. You're normally going to have to hold this property for 3 to 5 years, or pay a penalty for paying it off or refinancing it. So credit, the FICOs go down as low as 620. Oh, wait, that's actually the next page. I apologize. So rate and terms. Sorry about that. Rate and term, max LTV will be 80 to 85%. And then cash out, because they're a little bit riskier, they're going to be 70 to 75%. So on interest rates, this. I apologize, I jumped the gun. Yeah, this is where the 6 and 8.5%, and then FICOs. You don't need a great FICO, but it does help. But we can go as low as 620. And again, the FICO does affect the loan to value. If you have a FICO of 620, you're probably not going to be able to put down the minimum of only 15%. You're probably going to look at 25% or more. So just keep that in mind. We go that low, but it does adjust the loan to value of most lenders. And then every lender has every investor has a different goal. So we have different ways to structure these loans. There's flexible options. We offer fixed rate loans, ARMs, if you plan to hold it for a shorter period of time. So say you only want to hold it for 3 to 5 years. There are 3 to 5 year adjustable rate mortgages, and then you sell it and get out of it. There's also interest only properties, loan programs. So this is where you can get the biggest cash flow, but the balance is not being paid down. So you're hoping that the value of the property goes up. So when you sell it, you have a little bit more, you have a little more value in the home when it's sold, so you can pay off the full mortgage. But there are interest only options, and that maximizes your cash flow. Lenders typically require at least 3 months, 3 to 12 months of principal, interest, taxes, insurance, and association dues. So make sure you have assets even after the closing cost and the down payment. And then max loan amounts typically is $3 million, but I do work with lenders that go up to 4, and some will go exceptions up to $6 million. You just have to get that approved. So this is truly the ultimate growth catalyst, because each property qualifies on its own merit. Your personal debt to income ratios never become a factor. You can systematically build a real estate empire. It's also ideal for properties that you can hold under LLCs, which gives you an extra layer of liability protection. And most lenders, there's not really a max of how many loans you can get. A lender might cap it. I apologize. A lender might cap how many loans you can do with them, but they won't cap how many loans. Most of them aren't going to cap how many DSCR loans you can do or how many properties you can hold. So, like I said, this is a very short presentation. So just to wrap it up, DSCR loans are an indispensable tool for modern investors. There's no tax returns, no personal income scrutiny, and unlimited scalability. Whether you're a freelancer, a business owner, or a serial investor, this is how you accelerate your journey towards financial independence. So if you want to see some numbers on your next property, if you have something in mind, or just want to learn anything else, learn a little more, please feel free to send me a direct message, and let's discuss your situation. I do appreciate you joining me, and this will be posted on YouTube as well. Once I get the recording up and running, I'll post that link on Facebook so you can check it out there as well. Thanks. If you have any questions, drop them in the chat, or like I said, just reach out to me directly.